There is a regular drumbeat in the financial services arena about a new asset class and volatility. While the CBOE's VIX has led the way, a new volatility product from ISE will soon be added to the space. John Lothian News spoke with Scott Nations, President and CIO of NationsShares, about its new volatility index, what it is, and how it differs from the VIX.
As a trader in the pits, option trader in the pits here in Chicago for a long time, whenever anybody walked back into the pit, or more recently, whenever anybody sat back down at their desk and they wanted to know where the option markets were, they would talk about at-the-money implied volatility. They might ask, where's the at-the-money straddle? Well, what they're really saying is, what is at-the-money implied volatility? Nobody has ever walked into a pit or sat back down at a desk and said, please tell me what a strike price weighted average of every option trading in the front 2 months would be. That's not the way traders work. Why is that? Because the at-the-money options, that implied volatility, has the most information value. And that's what we've done with VolDex, is we've created a robust index measure of at-the-money implied volatility for SPY. SPY is the spider ETF on the S&P, the most robust ETF in the world, and the options that are the most liquid and frequently traded in the world. We measure strictly at-the-money implied volatility. That is, options, implied volatility of options in this month and the next month that bracket at the money. Compare that to the VIX. VIX literally uses every option with a non-zero bid in the front 2 months. A couple Fridays ago, I counted the number of options that would incorporate, and I quit counting at 400. Now, we're not saying that having 400 or more options in your index makes it a bad index. We're not saying that complexity is a bad thing. We're simply saying that in the option world, all this complexity, it's noise that drowns out what we really want to hear, and that is the information that we get when we talk about implied volatility from the at-the-money options. That's what we really want to hear. We created VolDex as an alternative to the VIX. We think it's superior for the reasons we've talked about, because it measures what traders really focus on, that is, at-the-money implied volatility. So we think it's superior to the VIX. Otherwise, we simply wouldn't have bothered. But we realize that a lot of people pay attention to the VIX now. A lot of people trade the VIX now. But we've created an alternative that we hope people will look at, say, yes, that is indeed superior, and they will trade our product. They will use our products. But we also realize that because of the differences in the difference in the way the two are constructed, the way VolDex is constructed versus the way VIX is constructed, that people will learn to trade one against the other. For example, if you wanted to isolate the impact of those out-of-the-money options, then you could trade spread, that is, VIX versus VolDex. And so we think that both of those markets will be important for us. That is, the market of organic VolDex traders and the market that is people who want to spread VolDex against VIX. Our partner, the ISE, International Securities Exchange, has gotten SEC approval, they've received SEC approval, to trade options on VolDex. Right now, we're in the middle of talking with futures exchange partners, and we expect to have that part of the puzzle settled very shortly. So we would expect both futures and options to trade on VolDex relatively quickly. Well, we think globally the volatility space is obviously important. You have to remember that a lot of option-based strategies, whether they're kind of packaged, are very popular in Europe. And those sort of structured products have been popular in Europe for much longer than they've been popular here. So we realize that people are more comfortable with some sort of embedded optionality in their portfolio in Europe and to a certain degree in Asia than they are here. So we think international opportunity for us is tremendous. That said, there is really right now only the one methodology. Again, we think we have a superior methodology. We look forward to working in Europe specifically, but also in Asia. And we've talked to a number of asset managers in Asia, as well as a number of index providers in Asia, who are interested in applying the VolDex methodology to their indexes. As long as the index has a robust option market, essentially any optionable asset class, we can apply the VolDex methodology.